go.
Yeah.
I don't hear the music with your
Yeah, I'm sharing. Yeah, I'm doing it now.
Okay, yeah, I can hear you now, but I don't hear the
Yeah, I got that. Share.
There we go. Okay, you good.
Hello, my name is Timothy Lee Raj Singh, and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. Inside this powerful course designed to transform your financial future, I've meticulously condensed over 1,000 of my public YouTube videos into 40 highly efficient lessons that span just 2.5 hours. This course is strategically designed into 4 phases to help guide your learning in the most logical and effective way possible. Phase 1 lays the groundwork, covering essential financial literacy like budgeting, banking, and taxes. In phase 2, you'll move beyond the basics, learning about brokerage accounts, figuring out how much you need for your own individual retirement. You learn about how to do fundamental research on companies, and you'll also learn how to conduct technical analysis by looking at stock charts. Phase 3 empowers you to build a robust portfolio and leverage your capital using advanced techniques like options and futures, and it also teaches you the importance of backtesting your strategies. Finally, phase 4 takes a deep dive into the advanced ICT concepts, giving you a professional edge. Each lesson includes a short quiz to help solidify your understanding. By the end of this journey, you'll have the confidence and tool that you need to make intelligent investing decisions, manage your money without fear or ambiguity. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here. Good evening, good evening, everybody. Hopefully everybody doing well. Sorry for my tardiness. Just getting in the house, had a lot going on. Yeah, man. I was trying to get on here as soon as possible. Y'all do me a favor, man. Y'all hit a like for the algorithm and subscribe to the channel if you ain't subscribed. And share this out with somebody who might get something out of it, man. We gonna let me back up. Good evening. If this is your first time tuning in to Tim's Tidbits, allow me to say welcome. But if it's not your first time tuning in to Tim's Tidbits, I still want to say welcome. But I want to give you a nice hearty thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., aka Aranya Grande. That's me, big spot of you to all bless, Spaniel. And you're in tune to another episode of the NQ Intraday Price Action Recap. Yeah, man. Man, shout out the hardest lieutenant on the tank, man. Shout out to the Russells, man. I ain't seen the Russells in a month of Sundays, man. The hardest lieutenant on the tank pulling up. Shout out to Russells, man. The hardest lieutenant on the tank, man. Hey, shout out to everybody who up in here. I see Kim up in here. I see Rhonda Green. I see here Learning Share up in here. I see the Russells up in here. I see that's my Discord. Get out of the way, Discord. Hide the Discord. Look at the Zoom. I see Marco post up in here like this here. Shout out Marco up in here. See Lump up in here. Steve. Rhonda trying to double dip. We already shouted out Rhonda. Get out of here. ICT must not be live streaming because Rhonda up in here with us today. Hey man, did price do anything today that caught you off guard? Did price do anything this week that caught you off guard? How about this buy program? That who would have ever thought, right? Who would have ever thought that the market was going to be in a buy program and just slicing through price action the way it did? Who did anybody think that? Did anybody have any idea? Did anybody have any idea that price would just be cutting through this efficiently delivered area to the left over here and charging toward the buy side?
I ain't looking at price, Tim, but did you get that drawback we were supposed to get on TGIF? Was coming Monday.
No, we did not get it. We did not get a TGIF.
We didn't get it. Oh,
so
okay.
what does that mean? That means it's a high probability that we get it on Monday. Right? Does that mean we have to get, just like did that what we said? It don't mean you have to get a TGIF, but you watch the signs to see if price is willing to give you a TGIF. And it didn't give it to you. Right? Right? It didn't give it to you. We'll get into the price action in a minute, but you never try to force anything on the market. You wait until the algorithm tips its hand and then you engage. Right? And then you engage. You feel me? I won't be surprised if we don't Monday. I won't be surprised either. It don't matter. Like if we don't get a TGIF on Monday, I won't be surprised. If we do get a TGIF on Friday, I won't be surprised. Right? Matter of fact, let me show you. If we do or don't, hold on. This is the perfect segue into my new shirt. Remember I told you I was making I made 2 new shirts yesterday, right? And I told you I was going to share my second shirt with you once I got finished with it. So, speaking of TGIF, if we get a TGIF on Monday, or if we don't give a TGIF on Monday, y'all like my new t-shirt? Hey, man. Hey. Come what we say. I'm not a bull. I'm not a bear. I'm a beast. You feel me? You know what I'm saying? You feel me? I don't care if it go up. I don't care if it go down. I don't care if it goes sideways. He'll learn shit. He'll learn shit sound like my mama. He'll learn shit say shake SMH. He'll learn shit SMH. Hey, my mama was on the phone with me today. I said, Pumpkin, I made 2 new shirts last night. You want me to make you one? She say, just because you told me you made it, I do not want one. I said, baby, you ain't even seen the design yet. Let me send it. I know I don't want it. If you made it, I don't want it. So I sent it to her. She told me something. I want none of the above. I say, baby, you got to get one and sit on the front pew of the church. Just sit all the way up on the front pew of the church. And then I say, matter of fact, don't wear them. Don't wear them, right? This is what I want you to do, right? I said, if they hold on. Let me get my feet together. Right? Let me get my feet together. Y'all hold on for a second. I say I want you to get both of them. Right? I want you to get both of them. And I want you to sit on the front pew, right? And then when the preacher start preaching, and he say something that ain't in accordance with the word, I want you to pull the shirt out your purse and say, "Hey, preacher." Just hold it up. Say, "Hey, preacher." and then if they say something, they have something slick to say, about you. You should look at them and say, hold the other one up. Be like, "Hey," they be like, "Sister Rogers, that ain't Christian like." Just look at them and say, "Hey." He'll learn to say, "I need help." Hey, okay, so, all right, again, going back, did price do anything this week that caught anybody off guard, right? So, if you've been tuned in to Tim's Tidbits, or if you're in the gang, we have talked about being on the right side of a market maker buy model, right? And when you're on the right side of a market maker buy model, you are primarily looking for opportunities to do what? Marco, when you're on the right side of a market maker buy model, excuse me. Now again, Marco, when you're on the right side of a market maker buy model, you are primarily looking for opportunities to do what? And where?
Accumulation.
All I heard was accumulation. I just caught the end. Say it again, Marco.
Accumulation?
Are you saying accumulation?
Yeah, accumulation. Can you hear me?
Yeah, I hear you. You saying accumulation?
Wait, accumulation.
You said
Like
wait.
what?
You said wait on accumulation.
Give me a second.
Sorry, no, I know.
What you looking for, Tim?
I said
on the-
buy at accumulation.
Oh,
Can you hear me
buy.
better
Oh,
now?
you said buy at accumulation.
Yeah.
Buy at okay, there you go. Y'all give it up for Marco, man. Marco said we are looking for, so I'll say it in the way I say it. We're looking for opportunities to buy. And the opportunities to buy are going to come when the algorithm stops at these moments of accumulation. You're looking for a manipulation of sell side and then an opportunity to buy in a discount. It's going to stop and accumulate. It's going to manipulate sell side. Then it's going to get on out of there, right? At the time when it wants to do it. So buy at accumulation. I'll take that. Shout out Marco. All right. Now, question number 2 goes to Rhonda Green. Right? When we reach our last stage of accumulation or distribution, we anticipate price to do what? We anticipate it to do what?
Let's see. So we got, after it has accumulated, expansion.
What are we looking for? It's our last area of accumulation or distribution. If we're in a market maker buy model, price is leaving our last stage of accumulation. If we're in a sell model, it's leaving our last stage of distribution. And at this point, we anticipate price to do what? This was, I also say this was the original silver bullet that I was introduced to. We're looking for price to do what?
Oh, I don't know. I'm gonna call him. I'm gonna phone a friend.
You phoning a friend? Who you want to phone? You got Lump, Steve, Joe, and Marco already answered. We ain't gonna mess up Marco winning streak right now.
All right. I know the answer.
No, you
No,
don't.
I know it.
No, you don't.
Huh? I don't know the answer.
If you knew it, you would have said it. Who you calling on?
I'm gonna know it when somebody else says it. Okay.
Lump, Steve, or Joe?
All right, we don't hear from Joe often, so let's go, Joe.
Joe,
Yes, sir.
when you hit the last stage of accumulation, this is the original silver bullet that I was introduced to. The last stage of accumulation on the right side of the market maker model, or the last stage of distribution on the right side of the market maker sell model. We're looking for price to do what? Give us a what?
I think you said, I don't know if it was yesterday or the day before, Tim, but you said, I think, just get more aggressive and move more quickly to, either that buy side or sell side liquidity.
We want to get that low resistance liquidity run, boom, right into the liquidity pool. Man, we want to see it go. We want to see it go. And that is why I started it out by saying, who didn't expect price to just cut through this area of officially delivered price section? Because if you turn your attention over here to our charty tart, and if I put it on a daily time frame, right, we can see that we said on this daily time frame here, we said that this market maker buy model, God dog it, come here. We said that this market maker buy model right here, it wasn't your average market maker model where you have several stages of distribution going down. We said we had us a smart money reversal, right? Then we went into this little range here, had us a low risk short right there. And then we just had like this one stage of distribution over here, right? So when we came on the other side of the market maker model, right? Once we got our smart money reversal, right? We had a slight little pause right here. So that means what? We only had like one area of accumulation. And this right here was our last area of accumulation. And what do we get when we got this expansion in this retracement? That's your original silver bullet right there. That's even, I'm going to hit y'all with an old school one. A unicorn model. Y'all ain't heard that in a while. You have a fair value gap in line with a breaker. Trade down into it. Pow! Non-stop. Right up into that liquidity pool. Right? Friday, Thursday, Wednesday, Tuesday, Monday. Non-stop. Just running right on up there. Right? So we had that. And if you go down to a 60-minute time frame, right? You can see it a little bit better, right? We had our smart money reversal, low risk buy, and this is our stage of accumulation right there, right? So this, and we only got one stage of accumulation. And then what did we not do after this right here? We did not retrace at all, right? Accumulation, got offset accumulation right there, manipulate the low, pow! Right there, up into that buy side liquidity, right? And that's why I started out saying, was anybody surprised about this? Was anybody expecting us to not just keep drawing up into the liquidity, right? We talked about that. Now, we said there ain't no guarantee that it will just continue to run, but you never step in front of a moving train if we have not completed the market maker model, if we have not taken out the liquidity. You do not just feel like, oh, it's been going so far, it has to turn around. No, let the algorithm show you that it's ready to turn around. Let it manipulate some liquidity. Let it give you a break in market structure. Let it give you a change in the state of delivery. Let it start showing you I'm obeying bearish order flow instead of bullish, or I'm obeying bullish order flow instead of bearish. Let it show you that it's doing that, and do not just step in front of a moving train.
Would it be fair to say that if you look at it on the 1 hour, it could be at right now, it could be at another stage of accumulation?
Sure. Sure, yes, because we're right there. We're just right. We're just accumulating right here, right? That right there. Anytime we just pause right there, right? Now, anytime we just pause like that, we are accumulating longs or shorts, right? We're always like consolidation. Now, I'm glad you said that. We don't want to misuse the terms, or we don't want to cross the terms or use the terms synonymously. I think that's the word I'm looking for, because we have a accumulation that means we're going up, right? We have a distribution that means we're going down, and that's inside market maker models. So inside of a market maker sell model, right, as price is going down, right, when you pause, these pause areas are areas of distribution, right? And then when you go into a market maker buy model, when you pause, these pause areas are areas of accumulation. And then if you look here, right, on the left side of a market maker buy model, you have your distribution phases. On the right side of a market maker buy model, you have your accumulation phases. And then when you look at the market maker sell model, there's your distribution, there's your accumulation. Okay, that's in the sense of a market maker model. Accumulation lets you know price is moving up. Distribution lets you know price is moving down. If you say I'm on the right side of a market maker buy model, right, then you know you're looking for reasons to buy. If you say I'm on the right side of a market maker sell model, you know you're looking for reasons to sell. Now, when price consolidates, right, you are accumulating longs and shorts. Longs are accumulating above price, shorts are accumulating below price, right? But this accumulation right here doesn't mean I'm going up or going down. This accumulation right here is just the prep phase, the precursor to what's about to happen. It's the precursor to the expansion, right? It's the precursor to the expansion, right? Now, this accumulation, right, it don't matter if you're in a buy program or a sell program. It's just a precursor to the expansion, right? Now, what comes next is the expansion, right? Right? So you got your, right, consolidation, aka accumulation, right? That we're consolidating right there, right? So that accumulation is your consolidation. What comes next is your expansion. Now, if you're in a buy program and you expand up, right, you want to look to the left and see if the manipulation has already happened, right? If the manipulation has not happened, then you anticipate price giving you a wig snatcher, because we're in a buy program and you want to continue up, right? If you are in a sell program and you get that expansion up, right, you're expecting this expansion to be the manipulation phase of your accumulation manipulation, right, of your AMD, because you're in a sell model. So this accumulation is the precursor. If you're in a bearish order flow and you expand up into the buy side, you're anticipating that to be manipulation. And then you're looking for a reversal instead of just a retracement, right? And then you would look for your retracement and your delivery, right? Your retracement and your delivery to give you the accumulation, manipulation, and then this distribution right here, that doesn't mean going down. That just means I'm offsetting positions below an old low or above an old high. So we have words that we're using the same words, but we don't want to use them synonymously or whatever the word I'm looking for. We want to understand why we're using them, right? We want to understand why we're using them, because once we get up here at our terminus, yes, this could very well be an area of accumulation. But since we have finished our market maker buy model, right, we've reached our terminus. So we're just looking at this right here as we're just up here distributing our positions right now, right? We're up here just, you know, soaking up either longs or shorts, right? We're soaking up either longs or shorts, right? Because we come in here, we're soaking up longs or shorts. And if we get like a pop and a drop like that right there, then this would right there would be our smart money reversal if we moved into the right side of a market maker sell model, right? So we always want to be careful at when we're using the terms, right? Because it can be two things can be true, right? Two things can be true. But once we reach our terminus, what do we say? Once we get to Picasso house, we sit on our hands and let the algorithm show us what it wants to do. Right? We sit on our hands, let the algorithm show us what we want to do. Do that mean we got to stay out of the market, right? Nah, you don't have to stay out of the market because you can always drop down, right? You can always drop down in your intraday time frames and look for opportunities to trade. But on the highest time frame that you've reached your market maker model at, you want to sit back and wait on the algorithm to show you what it wants to do next.
You know, if you get confused, so when you had the circles up, that first row and that third row were actually the same, correct? So the first row and then the third row, that row,
Right here.
yep.
Okay.
And then that last row is the same, right? Those are accumulation phases, correct? I mean, that's the
Yes.
same side. That's
Yes.
the same size of the model.
Yes. Mm-hmm. Yes.
Okay.
Yes. Yes. Because the models kind of go into each other.
Okay. So, like you said, so if that's the peak, I forgot the word right now.
Yeah.
The smart money reverse, if that's the smart money reversal, we anticipated it might just sweep those relative equal highs and then start hitting back in the other direction. So
Yes.
we would be the circle. So then we would be the circles in the middle.
You like right now for all this week we were here, right? But we only had like one stage of accumulation. We were here. And so now today, at the end of the day, we're right here. So now what this will be, like what the name of this right here, if we start out and go here and start and that becomes our smart money reversal up here, this is your initial consolidation. So right now, since we're at terminus, right now in your mind, you're thinking this is possibly my initial consolidation. That's what you're thinking right now. This is possible my initial consolidation because I just completed a market maker buy model, right? It doesn't have to be, but this is what you're thinking forward, right? So if you come here and like just get some type of manipulation of buy side and we come down and get a break in market structure right there, then you say, okay, this is possibly my smart money reversal, right? This is possibly my initial consolidation. This is possibly my smart money reversal. Then we come back up here and then it respect bearish order flow, and then we take out this low, then you'd be like, okay, that's definitely my smart money reversal because that's my low risk sell. We're on the right side of a market maker sell model, and now I'm looking for my first stage of distribution right here, and I'm looking for reasons to sell going down to right whatever their niche consolidation is. We can start here, that's a market maker sell model, right? We got one here, that's a market maker sell model, and then all the way down here at the smart money reversal, that's the terminus of the larger market maker sell model right there.
So that would be a beautiful spot for a wick snatcher, right? Because you figure if you fake it down, you get everybody in because they anticipate that it's going down anyway, right?
Yes.
And then you swing it back up, you sweep the highs.
Yes.
You got everybody trapped because I'm assuming that they're gonna get stops all-time high.
Yes.
You take them out and then you go back in the direction you started off with, right? So I guess that would be a good move to watch possibly for Monday.
Yes, you like, okay, for example, you said for Monday, right? This right,
Yeah,
let's
but
no, I'm
yeah,
just
that's
saying,
right.
cause we talked about Monday and we didn't get
The
a
TGI Friday, which would be the TGI Friday, right?
yeah,
So
we
you
didn't
figure you
get
do a
yeah,
wick snatcher,
exactly. So
which is
that's our
a bearish wick snatcher. You
mm-hmm.
go down because everybody's anticipating it going down anyway, and
Right.
then when they get in, you reverse it. You take out the highs because the highs should be. I'm just trying. This is just my thinking.
Yeah, and you're thinking
I
correctly. All right. So there you go. Right. This is our 20%. Right. This is our 20%. This is our 30% pullback based off our weekly range. Okay. I just adjusted it to the high that we made. All right. So let's say we come out Monday. Right. Remember last Monday we gapped down and got our 30%. Right. Even if we get a repeat of that, gap down, get our 30%. Or if we just do normal and then trade down to the 30%. Right. Hit our 30%. Go back up, make a higher high, right? Entice people in to go short, right? Go back up, rake them over the coals, entice people to keep going long, chase the longs, right? And then we come down and there's our smart money reversal, right? Because now we come down, make a low, take it out, come down here, get our break in market structure. There's our smart money reversal right there in line with our initial consolidation, right? Trade back up, right? We come back up into the range, get short there. There's our low risk short, and now we're off to the races, right? That would be like you said, a perfect example for a wig snatcher, right? Get your TGIF, rally up, and then break down, right?
you have to go down there 30%, or can you just go to that
Yeah,
doji,
you can just go here.
which would actually create the what do you call that? The change in character, change in oh my words.
Change the state of delivery.
Yep, there you go. If you go to that doji to the left between those two green candles, if you go there, everybody, I'm assuming that people who say, "Oh, we're going short," and then they reverse it as soon as they get in, and then boom, bring it back up and then bring it down. All right, cool. Thank you.
Yeah, you come there, you come there. The only reason why I was pointing out here is because that would give us, we're actually taking out liquidity on this time frame here. We're trading below getting a break in market structure. You see what I'm saying? That's why I came there. But we could just come here, go up, come back down. Same thing. Initial consolidation, breaking structure, right? This is smart money reverse. It's the same thing. Anything where you dip down, right, below the short-term liquidity there, go back up and go, that's a wig snatcher, right? And if you're anticipating this to be the initial consolidation, right, you're looking for signs, is the algorithm ready to go down, right? And we'll get into how we look for them signs in a minute. We talked about it several times already. We talk about it every day, but we'll talk about it in a little bit also, right? Got anything else? Y'all shout out Marco for pulling up with the hard hitting conversation today.
You put me in the factors a little more because I can get this right. So just trying to make sure that my thinking is on the correct. I got blessed today. I was able to work from home, so I was able to just watch the candlestick.
Mm-hmm.
I did set up a couple of boxes to see how it reacted, and just watching. So I just want to make sure my thinking is correct, because I'm like, are we going to reverse? Is this it, or should I put?
Yeah, I feel you. And sometimes you be like trying to figure it out, and we're gonna talk. I'm glad you said that, cause we're gonna talk about that. We're gonna talk about all of that. Looking at price, right? Looking at the looking for them signatures. Looking for them signatures. All right. I'll shout out Marco for pulling up with the hard hitting conversation today, man. Yeah. That's out. We don't need this TGIF. Get out of that TGIF. We didn't get it. We didn't talk about it. We didn't looked at our daily time frame. We had good enough conversation on that. Why are these showing up on these time frames? This right here. I did it from my phone, and I didn't close this out, so it's that's why it's showing up on these higher time frames when it shouldn't. Because I adjusted all of this on my phone, like I made these not show up on the higher time frames on my phone, and this was still open here at the house, and so those changes didn't translate over. Y'all like, what is Tim talking about? I'm talking about these little lower time frame things that shouldn't be showing when I go up in time. Like, see, that's a 5-minute fair value gap right there. That shouldn't be showing on the hourly time frame. Okay, 1 minute. All right. Who remember what we said about those 5-minute fair value gaps earlier today? Who was on gang? Who was on the call this morning? Right. Y'all was on the call. Y'all remember what we said about those? We'll talk about it once we drop down in the time. Y'all be thinking about it. Y'all be thinking about it. All right. So, looking at our hourly time frame, right? Let's go back and get us some reference material here to help us out. We're gonna put on our new week opening gap so we can see where we start the week off at. All right, that's our new week opening gap. That's where we started our week off. All right, and when we look at this, as we said, we had been stating since last week that we were on the right side of a market maker buy model. Right, we were on the right side of a market maker buy model. Okay, and so being on the right side of a market maker buy model, we look for opportunities to buy. And like we said, this market maker buy model didn't give us a whole lot of stages of distribution. Right, we just kind of like melted down. Right, so as we got our smart money reversal down there at our higher time frame liquidity pool, our long-term sell side target based off the continuous contract, right? Once we got that smart money reversal, right, and we came up here, right, at this area of accumulation over here, if you notice, we're right across from pretty much our only stage of distribution in this market maker buy model, right? So that means that this is our final stage of accumulation right here. And as we see, we got that low resistance liquidity run right into the buy side liquidity to complete that market maker model, right? There's not really much to write home about on the intraday time frame, right? As far as, hey, we expand, retrace. This, during this week, you had to really get in your ICT bag, right? And I can say that us as the gang, I feel like we was in our ICT bag when it comes to paying attention to what price has to offer, right? This is the time when knowing multiple parts of the concept pays dividends, right? When you're in, this is what we call a trending market. This is what we call a low resistance liquidity run. So this is the time when you need to understand, not all, you ain't got to understand all, but if you understand a lot of the things that Michael teach and you know how to apply them, then this is where that stuff really shines, right? Tim, what in the world are you talking about? Now, we saw throughout the week where we would go into regular trading hours, right? Let's go to a 15-minute time frame so we can get the information correctly, right? We would go to regular trading hours and we would look to the right of price, right? This is where we open up here, right? We would look to the left. I said to the right. We would look to the left in price and we would find stuff that the average Joe wouldn't be looking for, like new day, like opening range gaps, right? Old opening range gaps. We would look at those, right? And when you're looking at those old opening range gaps, right? For example, this opening range gap here, I think this is one of the ones that we were eyeballing throughout the time, right? So we closed here on one Friday and we opened here on that next Monday, right? Because this is a Wednesday. I said Friday. This is a Wednesday, and we opened here on a Thursday, right? So this is one close. This is the next day open, right? And then we come over further in time, right? We can see how price, right? We can see how price utilized that opening range gap, right? We was inside there accumulating, right? And once we left that area, we came back down and used it as support, right? You can see right there, we came to that upper octant right there and we took off, right? This is when we got our gap down. This is when we got our TGIF. We talked about we got gap down and got a TGIF. And where do we stop at? Right there at the upper octant of a very old opening range gap, right? We were identifying that as an area of support. We want to see that support price. Okay, talked about that. Not cherry picked, not made up, right? And then if we look over again, we have other areas, right? That you look at regular trading hour. We have areas over here, right? And then not only do we have areas of regular trading hours, right? We also, right, we're showing the power of event horizon throughout this week. All right, let's go back to electronic trading hours. All right, we go to electronic trading hours, right? And we said that when we traded above this high right here, right, these was our relative equal highs, right? Came up, took out our relative equal highs, and this was our liquidity pool. Well, Tim, it's a relative equal high. Let's talk about it. This high is higher than that high. So I just view this as a liquidity pool because we have taken that high, right? And this is now the liquidity pool there. This high is lower than that high, and this high is lower than that high. So we're coming up, leaving the liquidity. Coming up, leaving the liquidity. So these are relative equal highs because we're engineering liquidity. We're leaving that liquidity up there. So once we take out the relative equal highs, and then once, what are you doing? Get over there. Once we take out the liquidity pool right there, right? Now, what do we do? What did we do after that? We went in and start showing the power of event horizon. And Tim, what is that? So from this liquidity pool there, once we've cleared it, right, up here to our target, right, that's our target liquidity pool right there. These, right, we'll talk about those later, right, we'll talk about them later. But right now, that's our next liquidity pool right there, okay? So in that case, you take your Fibonacci tool, right, I got it set for event horizon, right, and you go to your high there and you come down to there, all right, come down to there, right, that's our high there. And now, right, we see how price uses the quadrants of that event horizon to stair step its way up. Lower quadrant, event horizon, upper quadrant, and then we take off, ping out, right? Non-stop, ping out, okay? Showed the power of event horizon. Now, you say, Tim, we got a liquidity pool here. Same thing, right? This is just our overall range. We did the same thing with the near-term liquidity pool right there, right? We came here, right? Come here, right? We dropped down into our relative equal highs over here, right? We dropped down into our relative equal highs right there. We got our relative equal highs here, our liquidity pool that we at, right? Price comes up, pauses at event horizon, right? Expands up, right? And then trades back down into that area that should act as support. Boop, then go up, right? We have been showcasing the power of event horizon all throughout this week, right? This is when understanding multiple aspects of the ICT concepts come in handy. Why is that? Because when you get to an anticipatory reactionary point like event horizon, or like consequent encroachment, like mean threshold, right? If you're coming up to it, right? If you're below it and you're bullish, you want to see price push through it. You don't want to see premium sensitivity. You want to see price push through it and then start showing discount sensitivity, meaning you want it to use it as support, right? And so once this is our event horizon for our very next liquidity pool, not to our terminus, but our very next liquidity pool. What happened when we got to that event horizon? We pushed through it and then we used it as support, right? We see discount sensitivity at that event horizon, right? Let's blow it up so we can see it well, right? And this right here, Marco, is what I was talking about when I said you don't want to guess and say, should I buy puts? If you're seeing discount sensitivity in a market maker buy model or in a buy program, you don't want to start buying puts, right? Why? Because we are coming up to an anticipatory reactionary point, event horizon, and we push through it. We don't see any premium sensitivity when we trade into it. We push straight through it, right? Once we push through it, right, we create a fair value gap in conjunction with that event horizon. Once we get above it, right, we're using it as support. We can't break back through, right? And then right here, we trade down into the order block, right? And wick back up. Everything is respecting that bullish fair value gap right there. Nobody's are trading below consequent encroachment of that bullish fair value gap on this hourly time frame for, once we created this next candle there, God dog it, come here. Right, so we've created it. So we come from this candle here all the way over to there, right? 15 hours. No candle was able to close a body below consequent encroachment of that bullish fair value gap for 15 hours, right? And then we, during that 15 hours, toward the latter end of it, we drop down into the bullish order block. And then when we come over here into this New York session right here, pow! We get on up out of there, right? And then we come above the upper quadrant. So we got a breakaway gap here, right? And then we got a bullish fair value gap at the upper quadrant. And then we set another bullish order block as we trade into that bullish fair value gap. Boom! Take off again and set a bullish fair value gap at the high of that event horizon area, right? So price is showing discount sensitivity, and then it's showing a bullish narrative of continuing a low resistance liquidity run, because we're not getting deep retracements back to the order block. We come back to the fair value gap after we left that area and we go, right? So we're coming back to a discount of after leaving this range, because if you come here and look at your equilibrium, right, come from the highest high of that point, right, and come down to that low right there, you see it drops to there. Now if you say, okay, Tim, that's the same candle, this is when we made the high there, right? You don't know when you made it. Even still, if you go to that high and come back down, well, that's still inside the low there, right? But you go to the highest high, we come back down to a discount, and make that fat so y'all can see it, right? We come back down to a discount of this area after leaving this area. So this is a balanced price range because we left it. We're not anticipating price to come back in during a low resistance liquidity run. So from that low that left it to that high, we came back to a discount. Low resistance liquidity run continued up, right? So price is still respecting bullish order flow. So as long as you're seeing that discount sensitivity, don't start trying to go against the grain, right? Just continue to ride along with the buy program and make sure you understand, hey, does the time frame above me have a reason to pull back deeper? If not, right, continue to attack that discount opportunity at the time frame you're watching, right? But if your higher time frame got a reason to come back down lower, then you say, hey, let me pull back. For example, here, right? We're going to look at this bullish fair value gap right here, right there, that bullish fair value gap on the hourly time frame. All right, we're going to just knock some of this off, right? Because we're going to look at this little retracement here, right? So we see here price expanded, right? When we came down to that discount, we expanded up. This is our range. That's the bullish fair value gap that's in the discount of the range on this hourly time frame. Okay, this right here is the new day opening gap from Wednesday, right? So this is when price opened up Wednesday at 6 p.m. right? We went up. This is 3 a.m. during London, and then we dropped down over here. This is during the New York Open right here. Okay, so we see price expanded and retraced into a discount. Now we're going to look at this area here, right? We're going to look at this area here, right, from the London to there, right? We're going to look at that area there on, would you look at it on a 1 minute time frame?
Before you leave there, Tim, quick question. So if you scroll back down to where you had that consolidation, in order for it to be a inverse, can the wick close it up? And then, like, you see that you got the order block, the propulsion block, right? You got that candle that closed up the fair value gap.
Talk about this?
Fair value gap. No, it's down where the consolidation is.
Here?
That one right there.
Okay.
So yeah, so that green candle, when that closed up that fair value gap, did it make it to an inversion, or it has to be a body?
Close
No,
which fair value gap?
The one to the left.
Here?
Well, that's part of the propulsion block that I'm gonna mention now. But that wick right there in the middle between
This wick right here?
the one on the bottom,
This wick right here?
right there, that one right there, did that make it into an inverse? And then that order block went into the CE of that inverse fair value gap.
Talk
Am I
about
thinking
here?
about that correctly?
No,
Yes.
no, this never became an inversion fair value gap. It was never closed below. You got to close below it to be it. Like the wicks do the damage, the bodies tell the story.
That's so never mind. Perfect. Thank you.
Yeah. So this, talk about this fair value gap here, right? See the wicks here, we're wicking. These wicks are doing the damage, but the bodies are telling the story. We're not closing. It just never became an inversion, right? That never became an inversion,
Wick.
right?
If the wick turns it into an inversion, but it doesn't. Okay, thank you.
It don't. All right. What was I saying? What was I?
You were gonna do the London, go on a different time frame with that.
Oh yeah, 1 minute. Okay, so going into our 1 minute time frame here. Remember we said this was our New York. This was our day open of the day here. We opened up there, right? And so if we come here, right at the London, we said we made the high during the London right there, right? So that's our high. That's where we made the high of our range, okay? And so looking at just this range here going into the London right here, right? Now we know this is the high that we made from way back there. But if we look here, right, we have this low, right? We dropped down, took out sell side, right? And we went up to this high right there, right? So this is our latest expansion of our overall range, right? That's our latest expansion of our overall range. So from this high down to this low right here, right? That's our latest expansion of the overall range. So then we come here, we consolidate, and we pop up there, right? Making a new high for this range, right? So now, right, this right here is our equilibrium for the latest expansion of our overall range. So we come back down there, right, and we get a bearish break in market structure right there. right? So we get a bearish break in market structure here, okay? Now, we get a bearish break in market structure, and so we say, okay, we got us a bearish break in market structure. Here's our sell side down here, right? That's our sell side right there. All right, so we come down, we got a bearish break in market structure, come in, we drop down, boom, we take out our sell side. All right, let's mark that there, make that red. All right, so we take out our sell side right there. Once we take out our sell side right here, and this is at 4:30, this is during the London, right? We come up and we get a bullish break in market structure right here, right? So now we've gone up, we're in a buy program, we get a bearish break in market structure, we come down and we take out our sell side, then we come back and get a bullish break in market structure on the 1 minute time frame. All right, so now that we got a bullish break in market structure, right, you will be targeting here. Okay, you're targeting right here, but what do we say? We're on a 1 minute time frame right here. Is there a reason for the higher time frame to go down? Let's see. Our higher time frame, which is our 1 hour time frame, which is our narrative time frame for a 1 minute, right? Our narrative time frame, we're in a premium inside our narrative time frame, right? This is equilibrium, and this is our discount PD array. That's from our narrative time frame, right? We look at 5 minute. That's our structure time frame, right? So for our structure time frame, right? For our structure time frame, the only thing we did for our structure time frame here, where we came down and took out this liquidity. Remember on our lower time frame, we got our break in market structure. Then we was targeting this right here. On our structure time frame, we just now got a bearish break in market structure. You know what I'm saying? So now on our structure time frame, we just got a bearish break in market structure right here. Right? So this is a bearish break in market structure on our structure time frame, right? But if we're zoomed in to our 1 minute time frame, we're saying, hey, we've reached our terminus and we just got a bullish break in market structure. So now we're offsides because the higher time frame just got a bearish break in market structure, right? And when we got this bearish break in market structure, this retracement back up that we're saying, hey, this is a bullish break in market structure again, we ready to go up. That's just our retracement on our structure time frame. Right? So on our structure time frame, we got consolidation, expansion, retracement. Right? That's just our retracement on our structure time frame. Okay? Why? Because our higher time frame has a reason to come down here. Right? And so when we go back to our entry time frame, right? And we see we came back up here when we say, oh, we got a bullish break in market structure there. Right? Now we're just consolidating. What are we doing? Right? Let's pay attention to this. Remember, right? Remember, PD arrays never go stale. Right? PD arrays never go stale. Remember that this price right here, remember that was your equilibrium inside that latest expansion of your price range here. This latest expansion right there, that was your equilibrium right there, right? When we went above it, see how we're seeing discount sensitivity right here and we go up, right? When we drop back below it, what are we seeing right here? We're seeing premium sensitivity right there. We can't bust through it, right? We're seeing premium sensitivity right there. Right? You say, Tim, we traded above it right there. Yeah, but what did we trade above it to? We traded above it into that first SIBI that was created as we was leaving there. Right? We're trading up into that SIBI right there. We're trading up into that mitigation block right there. Right? A bearish mitigation block. But we're seeing premium sensitivity at this old PD array, that old area of equilibrium. right? Then when we come over here, right? When we come over here, what do we get here? Right? We're seeing premium sensitivity. We drop down and attack the sell side first, right? So since we're seeing premium sensitivity and we drop down and attack the sell side, right? This is manipulation for anybody who's zoomed in too close to say, hey, we got a bullish break in market structure. We're in this area of accumulation. We dropping down, taking out sell side. We're about to go. You're seeing premium sensitivity right there at an old PD array. We're dropping down, right? And you get hit with a wig snatcher. Boom. Why? Because your higher time frame came down, got a break in market structure. You retrace back up to a premium, and now you're getting ready to go, right? This is how Michael trades his breaker, right? Because the higher time frame dropped down to a break in market structure, right? We rally back up. He's anticipating this to be a bearish breaker right there. So when price come up here and give him an opportunity to take a turtle soup right there above this high, because we're getting premium sensitivity right there. So when you see this fake down and rally up, right? You can take a turtle soup above this high. You can take a turtle soup above that high. If you take it, you can short based off this inversion fair value gap right here. Any kind of entry you want to take up here inside this manipulation. Then once you come down and get inside the bearish breaker, right? Let's mark out our bearish breaker right here. Anything inside of our bearish breaker right here, right? Once you come back, right, to anything inside the bearish breaker right there, right, you can be adding to it, right? You can be adding to it. And then look here, look at this manipulative move here during our going into our 930 open, right? We come up here and we rally up, right, above that high there. But where does it stop? At that old PD array. Remember the old PD array that we was using with this premium sensitivity right here, right? The premium sensitivity, when we come in here into our 930 open, right? At this point right here, price is bearish, right? So when we're over here, right, and we come into 930, what do? We shoot up first, and then we drop down. Bearish Judas swing coming off of this premium sensitivity here, this premium sensitivity here, bearish Judas swing, then price goes down into that higher time frame PD array.
Let him cook! I said let him cook!
Man, y'all do me a favor, hit a like for the algorithm. Subscribe to the channel if you ain't subscribed. I'm telling you, boy, they gonna ban me from YouTube if I keep doing this. They gonna ban me from YouTube if I keep doing this, right? And that's what we be talking about when we say, hey, let the algorithm show you that it wants to go down. Let it show you that it wants to go up, right? If you're seeing that discount sensitivity, the algorithm is saying, I still want to go up. If you're seeing premium sensitivity, the algorithm say, I still want to go down, right? Don't get tricked out of your bias because it goes further than you expect, right? Always understand, does the higher time frame have a reason to go there? Just like when we was doing the tape reading the other day, I think it was on Tuesday. And we was like, I was like, how do you trade this, Tim? I was like, you just buy the wick right here, set your thing accordingly, right? And you enter there, right? And when we was trading that wick, I said, but look, the 15-minute got a reason to come down there, right? So we came down to that 15-minute. I say now you be looking for that low resistance entry, that institutional order flow entry on this 15-minute, right? It hit the 15-minute and then it started to go back up. And then I went back and said, hey, look, if you took that trade on the 1 minute off that wick, you probably would have got stopped out here, but you don't give up because you got stopped out. When it comes to the higher time frame, you take your entry again at the higher time frame and it would have delivered to this, right? Because if you take that 1 minute, but the 15-minute got a reason to go down, you in the line of fire. You know what I'm saying? You're looking for, that's why I would say, you're watching this wick. Do we get body closures below consequent encroachment? You're watching this. Do we get body closes below consequent encroachment? You're looking at these PD rates based off the time frame that you're on, right? And then eventually it's going to revert back to the higher time frame. It may just keep going and going and going and going and going and going and going, and you're like, man, it ain't giving me no opportunity. But eventually it's going to revert back to what that higher time frame want to do, right? And you just got to look for the signatures of, hey, are we reverting back right now, right? Anybody got anything before we look at our New York session from today? Anybody confused? Yeah, go ahead.
It's a higher level question, but can you go back again and just kind of walk me through how I would assess structure? Like I didn't want to interrupt you because you touched on it earlier, but you were right in the middle of a point. You were cooking. So, but that's one of the things that I somehow keep missing. Like how, and you talk about it all the time: structure.
Mm-hmm.
And I'm trying to. I'm looking through my notes and I don't have anything on it. So could you kind of walk through what I'm looking for to assess structure at any given time on any time frame?
Okay, so for structure, you want to we're gonna start at a daily time frame, okay? All right, and when you think about structure, you want to understand that whenever you're looking at price and it starts to like consolidate or go into like time distortion, you want to bump up in your time frame and see what's going on like immediately to try to figure out where am I in the structure, right? When you go into areas like this, you want to bump up immediately, be like, okay, where am I in the structure? So just keep that in mind. But when we're looking at our daily time frame now, okay, in its simplest terms, right? In its simplest terms, when you talk about structure, you're just looking at areas of algorithmic support and resistance, okay? And what do I mean by that? You're looking for areas that have been efficiently delivered, both buy side and sell side delivery, not to be confused with like liquidity, right? So buy side delivery is nothing but price going up. Sell side delivery is nothing but price going down, right? Now this can be in the form of a consolidation where we offer buy side and sell side delivery that makes it efficiently delivered, or it can be in the sense of a trending market where we offer sell side delivery and then we offer buy side delivery. That can equal efficiently delivered price. Once you get buy side and sell side delivery in an area and then you leave it, that gives you a balanced price range, right? Meaning that the algorithm is done with that and now it's going to either use it for support or resistance, okay? So once you understand where's the price efficiently delivered, then you want to identify, are we in a buy program or a sell program? Meaning, is price respecting bullish order flow? So a buy program, right? BP. Is price respecting bullish order flow? What do you look for, right? Down close candles in a buy program, you want to see price closing above the mean threshold of down close candles. If it's one candle, right, you want to see it closing on that time frame, right? On the time frame that you're looking at, right? You want to see it closing above the mean threshold. If it's just one down close candle by itself, right, you want to see price closing above 50% of that one candle. If it's consecutive down close candles, right, you want to see the candles closing above 50% of those consecutive down close candles. That's one sign that you're looking at for a buy program or bullish order flow, right? You want to see price pushing through bearish PD arrays, right? You want to see price pushing through bearish PD arrays. Like if you got a SIBI, right? You want to see price closing above consequent encroachment of that SIBI, right? You want, meaning disrespecting the consequent encroachment, right? You want to see it pushing above the consequent encroachment of the SIBI and closing above. You don't want to see premium sensitivity at that. When it get there, right, you don't want to see the algorithm defending the upper half, right? You want to see it get above it and start defending the lower half. You want to see that discount sensitivity at the lower half. That's another thing you look for bullish order flow. All right. And so once you identify, okay, I see the buy side delivery, I see the sell side delivery, I see that we are in bullish order flow, I see that we're in bearish order flow, then you want to start paying attention to your dealing ranges, right? Your dealing ranges is what's going to give you your structure breaks, right? Your breaks and structures, right? So a dealing range is created when you take out buy side liquidity, right? So if you got a high right here, we trade above that high right there, right? Price trades above that high right there. And then we got a low right here, right? You got a low right there, right? Price trades below that low right there. So once we take out that buy side there and we come down, we take out that sell side right there. Now we got a bearish dealing range right here. So now we're inside of a bearish dealing range, right? If we trade above this high right there, we're breaking outside of a bearish dealing range because we took out buy side first, then we took out sell side. So now we have a bearish dealing range. If we trade back up and take out that high, that's a bullish breaking market structure because we created a bearish dealing range, right? And then we traded outside of that dealing range to the upside. That gives us a bullish breaking market structure, right? If we trade outside it on the low end, right, we're extending this dealing range, right? We're extending this dealing range down, right? Come here, you, right? We extended it down there, boom, right? So now that's our entire dealing range right there. If we break out to the downside again, boom, we're extending it down. We keep extending that dealing range. That's not a breaking structure because we're in a bearish order flow, so we're not breaking structure. We're just continuing to expand. Now, a lot of people say, oh yeah, you're breaking outside of structure, right? I don't look at it as a break in market structure because we're just expanding this dealing range further and further and further down, right? Now you have some people that say, yeah, we're breaking outside of this structure. No, we're just expanding lower and lower and lower. Right now, once you have an efficiently delivered area like this right here and you leave that area, now this is a balanced price range, right? And if you're in a sale program and you haven't reached your destination, now you anticipate in this balanced price range to act as resistance, algorithmic resistance, right? You want to see premium sensitivity, meaning when you trade back up to it, you want to see price unwilling to push through this area, right? And as we trade back up, it comes back down. Trade up, comes back down. Trade up, it displaces back down. Creates a bearish fair value gap, creates another bearish fair value gap, and then we trade into our area of liquidity where we're looking to go. All right. And once we trade into our area of liquidity where we're looking to go, now we're in a sell program, and then we come back up here and we immediately close above mean threshold of this bullish order, potential bullish order block, these down close candles, right? These down close candles, we immediately close above mean threshold of them down close candles. That's not respecting bullish bearish order flow. We immediately close above this SIBI right here, right? And that's the first SIBI That's the first SIBI that's created when we leave this area right here. Remember, this was our balanced price range because we left the area. Then we offered buy side and sell side delivery right there. Then we left that area. So now this is the first SIBI that we created once leaving this area, and we immediately close back above it after taking liquidity. Now that's an inversion fair value gap, right? That's an inversion fair value gap. So we create an inversion fair value gap, right? We close above these down close candles mean threshold, right? That's all bullish order flow, right? We create a BISI, right? We create a BISI, right? And we come back down into that inversion fair value gap. And now we're seeing discount sensitivity at the inversion fair value gap, discount sensitivity at the BISI right here. And now we're consolidating here, right? God dog it. Come here. I'll just borrow this one. I don't know why it don't be wanting me to let me click it, right? Is there a space there? No space. All right, come back here. There's space there. No space, right? Then we come back here, and this is where it gets a little confusing sometime, right? We said this was inversion fair value gap because that's the first one leaving this area. Now this is the first fair value gap created on this displacement down, right? And now notice, right? We are respecting, we're getting discount sensitivity at this fair value gap right there, right? So when we close above that open right there, now we have an inversion fair value gap because that's the first one created on this way down, right? Tim, how you got two first? This is the first one leaving this balanced price range, right? This is the first one in this entire move down from here, from leaving this area here, right? So that's a first, right? We see discount sensitivity at this PD rate. That's bullish order flow, right? So you got bullish order flow there, you got bullish order flow here, and then we come up here, and when you offer the highest price of the highest opening price of these consecutive candles there, that gives you your change in the state of delivery, right? That gives you your change in the state of delivery after you've gone down and taken out liquidity, right? So once you get your, right, you get your change in the state of delivery right there. This right here is your, that's your, I'm bullish now. Right? This is your confirmation that price is bullish now. This is a signature that is bullish. That's a signature that is bullish. But that change in the state delivery, that's your confirmation. What makes that your change in the state delivery? Because these down close candles there are consecutive down close candles that traded into a higher time frame liquidity pool where you was anticipating price to possibly reverse. And then so when you trade back above that opening price, that makes this a bullish order block, and that gives you your change in the state delivery. You're no longer bearish, you're now bullish. So now when you trade back above, right, this high right here, that high took out that low right there. That's a break in market structure, right? Because you were bearish and now you're bullish. So you got your change in the state delivery, you got your break in market structure, right? So now, right now you're bullish. Now you're on the right side of a market maker buy model. You got your smart money reversal, right? You got your break, and that's how you walk through the structure. You know what I'm saying? Paying attention to, okay, what am I hitting? What am I creating? Those are your different points that show you, okay, this is, you know, this is still bearish order flow. We're still extending down. Okay, we've come into a liquidity pool, right? We got a change in the state of delivery. Then we got a bullish break in market structure because this swing high right here came down, took out that low, went into a liquidity pool. Then we came back above that high, right? And then if you are looking like, hey, that's really not a good breaking structure for me because it's still inside here. Okay, I get that, right? Some people want more of a breaking structure. Trading back above this high would be the breaking structure, right? because you have, you know what I'm saying, more of a move, right? So it's just depend on how much of a confluence you want. I mean, how much of a confirmation you want, how much of that. But when you see, you know what I'm saying, you learn how to identify where your things, because you're breaking market structure, right? Most of the time it's going to be very near your change in the state delivery. Now, sometimes you may have only one down close candle down here, right? And then your breaking structure be up there, but it ain't gonna be super far away. Your change in the state delivery ain't gonna be like down here, and then your breaking market structure is all the way up there. Your change in state delivery is gonna be, you know what I'm saying, relatively close to that breaking market structure.
Right.
Makes sense?
Yeah, no, that's perfect. Next question is, right, that swing high that sent us all the way down to the low, the one you just touched at the top,
Right here?
using as an example. No, up to the left, and yeah, that one.
Mm-hmm.
So on the way up to that high,
Mm-hmm.
right to the left of there, that lower high, price trading above that would be considered a break in market structure. So that, yeah, that little area right there where it traded above is would I call that a break in market structure?
It's one of them yes and no things, right?
Okay.
The reason why I say yes and no, because for this fractal of price, yes, that is a break-in structure, because you're going outside of this bearish dealing range, right? Yeah. But you got to remember, this bearish dealing range sits inside of this dealing range right here, right? So this is your parent dealing range there, right? And then this is just a dealing range that's inside of there. You follow what I'm saying? So it's like, so right here we expanded down, and then we came back up, and we're just consolidating inside this bearish dealing range right here, right? So you have, right, this, you got this little dealing range there, right? And then we're consolidating inside of that dealing range, right? So this right here is inside there. Tim, how can it be so many dealing ranges? Because you're taking out liquidity on both sides. So that's a bearish dealing range right there, right? Over here, you're taking out liquidity on both sides. So that's a bearish dealing range right there, right? But it's a subordinate dealing range inside of others, right? That's why I say, yes, that is a breaking structure for this dealing range, but for the higher time frame narrative, right? All of this right here is just time distortion. Like from this point here over to this point here, that's all time distortion right there. Like just cut all of that out like this, and you look at it as this right here. You see what I'm saying? And then this is time distortion right there. So you cut all of that out, right? Cut all of this out, and you look at it like this. You see what I'm saying?
Yep. I think the answer is perfect too. But you said yes and no. So I get ate up when I'm trying to paper trade, and I'll see that little break in market structure
right here.
And I think it's time to either go long or short, and then I get stopped out. And so your answer is perfect, because it's basically saying yes, that's technically a break in market structure, but Joe, you got to look at the bigger picture when you're making these trades. So that's
okay. I'm glad you said that. I'm glad you said that. You said you get chopped up looking at this. Okay, this is what I want you to start doing from now on, right? Now, mind you, a lot of times you might miss some trades, but this is what I want you to do. Okay, we're just gonna say, we're gonna pretend like this is not a daily chart. We're gonna say that this is like a 15-minute chart, 5-minute chart, whatever, right? Okay. So we understand that we got a bearish dealing range that we're in right here, right? We said this is our high, this is our low, right? This is our parent dealing range that we're in. Okay, let me take this other stuff off. Let me take these lines off. All right, so, right, this is our parent dealing range right here that we're in. Okay, so we say, okay, we're in a bearish dealing range. All right, so I'm looking for reasons to sell in the premium. All right, so we come over here and we're chopping around. We're saying, okay, this is just time distortion here. We're chopping around, and we're going to get right here where you say, okay, this is where I get chopped up. All right, so I'm going to come here. I'm going to mark out. Let me delete that. I'll just get a regular line. Right, so I'm going to mark this here. All right, and we're going to make this green. All right, for some buy side liquidity. Okay, so this is what I want you to do from now on. Okay, so when you're in a situation like this and you're watching price and you say, okay, we're in a sell program, and I see we come down here and we're chopping around right here at equilibrium, right? I'm seeing premium sensitivity here at equilibrium, right? Then you get this break in market structure. You say, oh, we got a bullish break in market structure, right? When we get that bullish break in market structure, the first PD array that we form going up, that first fair value gap that we form going up, right? I want you to wait to see if you get premium discount sensitivity or if we push through it and create an inversion, right? So that first, when we take off, right, we take off and take out that liquidity, that first fair value gap that we create, that's the first, right?
Right.
If we come back, you see right here how we instantly disrespected that consequent encroachment right there,
Yeah.
right? And then the next candle we came and we closed below it, right? When price trade back up into that, short that instead of trying to buy that breaking market structure, because you're in a bearish dealing range, right? And price attacked buy side, right? It's attacking buy side first. So this is where you want price to, because where are we right now? We're in the premium of our dealing range, right? So when we come and attack this buy side, you want to make price prove to you that it wants to continue up, right? So that first fair value gap that's created, I don't care if it make 1 and then 2. That first one that's created when we're leaving that area right there, right? Now, if we create one way down here, look at the one when we're leaving the area, right? The first fair value gap when we're leaving, like this one here is when we're leaving that area. See, we're here, we're leaving the area, and there's your gap right there, okay? If price comes down and you get discount sensitivity right here and we push back up, then you can think about buying to continue up. But if we're in the premium of our bearish dealing range, look for that first one to give up the ghost. If it gives up the ghost, then short that instead of trying to buy long there, because you want to make price prove that it wants to go, because you're in a premium of your dealing range right now, right? Don't get caught up in these subordinate dealing ranges here, because this is still your dealing range. Because why? We haven't traded outside of it. You see what I'm saying? This is our dealing range. We're still looking for opportunities to trade inside this. We haven't left this range. So anything that happens inside here, you want to be in accordance with the dealing range that you're in, the parent dealing range that you're in. Okay, so if you see a breaking structure here, right, make it prove that it wants to use that as support, right? And even if it immediately gives up the ghost, that's better. But if it don't immediately give up the ghost, still make it prove that, because if it come here and you see discount sensitivity, but it's refusing to get back above that high, it's not doing its job. It's not pushing me up, right? If it's going to give you discount sensitivity, you want to see it continue to make highs. You know what I'm saying? You don't want to see it just resting here, refusing to go higher, right? You're waiting, just wait, be patient, and then once it gives up the ghost, short that, right? But if you get that discount sensitivity and then you take out that high right there, right? Then you can say, okay, now I'm buying in on this order block. I'm buying in if we touch that again. I'm buying something over here. Make it prove that it wants to continue up, right?
Mm-hmm.
Make sense?
Yeah, that's perfect. That's perfect. It's and if I'm honest, along with the technical stuff, I probably need to work on being more patient.
Oh yeah, we all do. You are not alone. You ain't by yourself. We all got to work on being more patient. And y'all give it up for Joe, man. Pulling up with the hard hitting conversation / questions. Hey, let's go ahead and look at the New York Times. Let's go ahead and look at I think this is stuff that I was just writing in. I don't need none of this. Let's look at our New York Times from today, and then we'll go ahead and call it a day. We'll go ahead and call it a day. Let's drop down. I'll go ahead. I'll just drop down into like a 1 minute time frame. Just go straight to the 1 minute. I'll turn on my fancy dancy New York from the pre-market over to new movies to watch. Over to the close. All right, so this is our New York session for today, from the pre-market over to the close. Gang, y'all know we as we go in every day, we always talk about our pre-market high. This was our pre-market high here today. Okay, this was our pre-market high. Let me make these a little bit bigger so you can see them, right? And this was our pre-market low all the way down here, right? So price was in a very strong buy program when we opened up on the day. We talked about the possibility of having a TGIF because it was Friday, price being in one direction. But what did we say? We said, do not try to force a TGIF, right? We said that right now, this is our pre-market low down here. This is our pre-market high, right? And we opened up 9:30 right here. This is our 9:30 open, right? If you can't see it, let me make that a little bit bigger for you, right? That's our 9:30 open, okay? So opening there at 9:30 right here, right? We said that we were in between the tail of two cities. We had a 5 minute, right, BSI right here, which was an inversion fair value gap, right? If we look at this here, right, this was an inversion fair value gap because it was created back over here at like 8 something in the morning. And this right here was this was a BSI, and this was the inversion fair value gap. 5 minute inversion fair value gap. This one here was the inversion fair value gap, and this was the BSI, right? So a bullish fair value gap, that's an inversion fair value gap, is now a bearish inversion fair value gap. Okay, so we got a bearish inversion fair value gap and a BSI, which is a bullish fair value gap. So we're in between the tail of two cities. Okay, we said don't try to force a TGIF until we get a meaningful break in market structure, right? And looking at price, right, looking at where price was, right, we had a nice strong rally, and until we came down here, right, we wouldn't get a meaningful break in market structure, right? If we pop up to like a 60-minute time frame, right, we just pop up to a 60-minute time frame real quick and look at our structure, right, on the 60-minute time frame, right? Our true breaking structure would be down there on the 60-minute time frame. Like on a 15-minute time frame, see my line there? We're coming down below that order block right there. On like a 15-minute time frame, 5-minute time frame, that would give us a bearish breaking market structure. 60-minute, that would give us a bearish breaking market structure. But from our 9:30 open, we had quite a ways to go before we got a bearish breaking market structure, right? So we didn't want to try to force a TGIF. Just say, oh, we've been going in one direction, we got to sell off. No, we don't have to sell off. What do we talk about? Looking at that premium or discount sensitivity to let us know what is price going to do, right? I shared a trade that I took with the gang today. Again, like we said, we have been highlighting other aspects of the ICT concepts to help guide you in your interaction with trades, right? I said for everyone that was on the pre-market call today, this is an example of scalping inside the range we defined using the first presentation as an inversion fair value gap near the upper octant of the discount 5-minute fair value gap during a macro to target event horizon between our premium and discount fair value gaps, right? Meaning between our inversion, bearish inversion fair value gap and our bullish fair value gap, right? If you run, I got another event horizon here, right? Oh, we talked about this event horizon right here also when we were studying price, right? We got our liquidity pool. If you can't see, that says buy side liquidity with B adjust on. I got that from the continuous contract. When you turn the B adjust on, that was the all-time high, right? When you look at the front month, this is the all-time high right here where it says next target. That was our next target, right? So run a fib in between that high, that liquidity pool, and that liquidity pool. That gives you event horizon right there. Notice how price uses not just event horizon, but the quadrants in between those areas right there, right? Right? But it ain't no algorithm. Now, back to what I was saying, okay? Right, we're gonna borrow this event horizon right here, right? So if we go to the high of this lower fair value gap right there, and we go to the low of this upper fair value gap right there, right? Let's make sure we get the numbers right. That's going to be 74 even and 96.25, right? So 74 even, 96.25, right? So right there. And then we said during a macro time and use the first presentation, right? So we're going to find our macro window. We're going to go to 950 over to 1010, over to 1010, right? Macro window. Okay. All right, so this is our macro time. All right, so if we look here, we see here that this is our first presentation, right? This is our 9:30 open, right there. You see here we open at 9:30, and we're kind of dilly-dallying back and forth, right? As we displace down here, that's the first imbalance that we create on this displacement since 9:30 in the morning. That's our first presentation. It is a bearish fair value gap. Okay, so we got a bearish fair value gap, right? And if you notice, right, this is our 5-minute bullish fair value gap that we said we were in between a bullish fair value gap and a bearish inversion fair value gap, right? We are seeing, right, we're seeing discount sensitivity, right? We come down here, right? We trade down here, down to the lower portion of it, come back up, right? Staying, like, we close below consequent encroachment, immediately get back above, right? Now, let's look at a 5-minute chart. These are just 1-minute candles, right? Let's look at a 5-minute chart of that same area, right? Looking at a 5-minute chart of that same area right there. Look at all the 5-minute candles in relations to that consequent encroachment. Discount sensitivity. All right, back to our 1 minute. Okay, on our 1 minute time frame, right, we are identifying this discount sensitivity on the 1 minute time frame, right? We come down, immediately get back above, fail to take out that low, right? Constantly closing above consequent encroachment there, create a bearish fair value gap as we're trading down into an anticipatory reactionary point, and then we come back immediately. This is what I was talking about here. When you're watching price, right, we're bullish right here, but price is going down, right? So it come down, create a bearish fair value gap, right? I'm not trying to short this. I'm waiting for this to become an inversion and see that premium sensitivity, right? So we come back above there, right? We come back above it here, right? We close back above it here. We trade away, take out liquidity, right? So what does that give us here? A bullish Judy swing, down, up, take out internal sell side. Short-term sell side, short-term buy side. Boom, boom. So you have a inversion fair value gap, you have a change in the state delivery, and you have a bullish Judy swing. All this bullish order flow at our anticipatory reactionary point, right? At an area where we're anticipating price to be supported by the algorithm, right? We come down here, right? What do we get? Discount sensitivity at this inversion fair value gap, right? Drop down, can't make it to it, right? Come here, right? Drop down, boom, right? Dig down into it. We're coming below this low, and this time we trade all the way down into the BISI, all of that right there, right? Come back up, can't get to it again, right? Then we displace away, take off, gone, right? As we're taking off and going, right? We create a BISI right there, right? Create a BISI right there. This is our, right? Our range there. Coming down, we're leaving this, all this efficiently delivered area right there. This right here is when we're leaving this area right there. Boom, taking off. This is our discount BISI right there. We trade down into the discount, right? And we continue to move up, and we move up into our inversion fair value gap, right? Once we move up into our inversion fair value gap, right? Watch this here, right? Once we move up into our inversion fair value gap, right? Remember what we said about PD arrays never go stale, right? We come here, let me put a line, vertical line here for a second. Put a vertical line, that's 10, 20, 10, 15, right there. Now, go up to a 15-minute time frame, right? Go up to a 15-minute time frame right here. So this right here, right? As we come down, this is a 15-minute time frame, okay? We drop down, right? Move back up right there. Let's go to a 5-minute time frame so we can see all the PD arrays good, right? So 5-minute time frame, we move down there, right? We move back up, and we'll talk about the discount sensitivity at the 5-minute PD array, right? We move back up as we expand back up now, right? When we look here on our 5-minute time frame, right? On our 5-minute time frame, what are we doing? We're dropping back down, right, into a 5-minute suspension block right here. Right, we got a 5-minute suspension block. Right, I'll just make it light blue so we can see. Right, I'll make it blue. Right, we expanding up, retracing back down into a 5-minute suspension block that's in the discount of our range, right, throughout that macro time, right? We got our efficiently delivered area there. We're leaving that area on this 5-minute time frame. We're dropping back down into a discount. This discount PD array right here that was created during the macro time, right? The 5-minute has a reason to come down there, right? Now, on the 1-minute time frame, right? Remember we said the 5-minute has a reason to come down there. On the 1-minute time frame, right, we come back up into our inversion fair value gap, and we're chopping and slopping inside our inversion fair value gap, right? We come up here, we make a high right there, we drop down, make a low, right? We trade back up here, then we break down below these lows, right? What does that look like? That look like we got a bearish break in market structure. That look like we got a smart money reversal and a low risk sale, right? We're dropping down, right? Price is displacing away. It's ready to go down because we're too high. But no, the 5-minute has a reason to come down there, right? On the 1-minute, where does it come to? And the 5-minute, event horizon, right? Remember, we was below event horizon, and what we saw, premium sensitivity. we got back above event horizon. What do we see? Discount sensitivity. And then we got on up out of there.
Let him cook! I said let him cook!
Man, y'all do me a favor, hit a like for the algorithm, subscribe to the channel if you ain't subscribed. I think I'm done talking, man. Unless somebody got something for me. I can't say it no clearer. I don't know how to show it no clearer. I mean, I don't know. I don't know. Hey, what's up, Tasha? Tasha, hey, Tasha, tell Snoopy I said.
Do you know why we can't hype your videos?
You
Is there a
said
reason? Is
you
there a
said
reason?
you can't hype. What you mean hype? What I don't know what that means.
So basically, when I watch other people's videos, it gives you a hype button, and normally you can hype 3 videos a week. But for your videos, for whatever reason, the hype button's not there.
I don't know. I'm about to research that. I don't even know what the hype button is.
Yeah, so basically you hype. So like if I watch you on YouTube, there's a hype button by where the comments are,
Mm-hmm.
and then get points, and that what that does, that spreads stuff out for you. But for whatever reason, your videos don't have it.
Maybe it's something that you gotta turn on. I don't know. What is the hype video button on YouTube? The hype button is a YouTube feature designed to help gauge creators those small to mid-channel gain visibility beyond their existing subscriber base. Think of it as a super like that carries actual weight. YouTube weekly allowances. You receive 3 free hypes per week, which refresh every Monday. Discover how it works. The smaller channel bonus, YouTube uses the point multiplier based on subscriber count. A hype for a channel with 5,000 subscribers is worth significantly more points than a hype with 400,000 subscribers. Love field and badge video. Okay, eligible requirements. To have the hype button appear on your video, a creator must be part of YouTube. I am that. Have 500. I got that. Upload long form videos. It is currently not available for shorts, live streams, or content made for kids. Maybe it's not available for live streams. It probably would have to be a video that what's considered long form, longer than how much. Okay, it might be like one of the other videos that I like when I be uploading the gems from the live stream. It might be on those if they over. What is considered long, what is it? What do they call it? Long form? What is eligible for? What do they call it? Long form? Yeah, they call it long form. Long form on YouTube. Okay, defining long form. I should have put it on fast instead of thinking. In 2026, long form primarily defined by what it is. Duration, any video longer than 3 minutes, regardless of shape, orientation, horizontal videos. If it's only 15 seconds long, okay. Older vertical videos, say okay. Monetize ads, standard. And so it say any. All right. Max now. 3 minutes for shorts, 12 hours for long form. All right. So I guess anything that I put in there, like inside my let's see here. So if I go to one of my videos, videos. Okay, this right here. This video right here is 15 minutes long. That video is 15 minutes long. If I go there. Shut up. All right, so I don't know if you can do it. I guess I can't do it to myself. So what would it be like down here somewhere?
Yeah, so it's basically on your phone. I've never seen it on the desktop, to be honest with you. I've always see it on the phone. But I'll go through your old videos, the ones that were live stream, to see if it shows up.
Yeah, like look at the ones.
And then what I'll do is I'll take a screenshot and then send you I'll throw it in Discord so you can see what I'm talking about.
Yeah. Look on like the gems from the live stream and see if it show up. Cause it says it's not there for live streams. So the live streams, it ain't gonna show up. But look at the gems from the live stream that I'll be sharing and see like right here. Like these videos here, they say anything over however many, like all of these is over 10 minutes. So I know that should qualify. You know what I'm saying? Like all of these is over 10 minutes. It said as long as it's over 3 minutes. But yeah. Yeah. Ain't no thing, C-Walk. I appreciate you. Who that is? K-Mox. Hi, just randomly arrived on your stream. It's great. I finished the ICT 2022 mentorship. I'm from France. All right. If the only thing you finished was the 2022 mentorship, K-Mox, if all thing you went through is the 2022 mentorship, you need a whole lot more information. Because the 2022, that's just a model that's given for people who understand the concepts already. Right? You already understand how to identify order flow. You already know how to identify the draw on liquidity, and that model is just that's just a entry model, right? So if you don't understand order flow, if you don't understand how to find a draw on liquidity, that model, you're just going to be a pattern trader and you're just guessing, right? And you're probably going to end up hurting yourself. Because especially during times like this, when price has been very difficult, you know what I'm saying, over the last year at least, you're gonna get slapped upside your head, You need a whole lot more learning than that. What else I see over there? You did your thing today. Thank you for not rushing your expectations and for being so thorough. Hey man, give it up for yourself, man. I thank y'all for pulling up and asking the hard-hitting questions. What's up, Wild Deuces? I ain't never seen that. Yes, I understand, but ICT doesn't teach patterns, but order flow and context. Yeah, that's what I'm saying. If all you know is the 2022 model, then you're just going to be trading a pattern. You have to understand, because the 2022 mentorship, that's just a entry model. That's all it is. It's just an entry model. It's not teaching you how to see the order flow. It's not teaching you how, because he teach you everything in core content. He teach you order flow. He teach you PD arrays. He teach you narrative. He teach you draw on liquidity. He teach you everything in the core content. And then in 2022, he gave you a model. In 2023, he gave you something. 2024, he gave you something. 2025, he gave you something. It's like he was just giving you different models based off the core content that he already taught. You see what I'm saying? So if you don't understand the core content and you just come in, like people be like, which ICT mentorship should I watch? Go watch the core content. Because that you need that before you watch any of those other videos. Because if you just watch them other videos, all you're doing is looking for that pattern. All you're doing is looking for that sweep of liquidity, that break in market structure, and then that entry. You're just pattern trading. You don't understand. Are we in bearish order flow? Are we in bullish order flow? Are we on the right side of a market maker buy model? Are we on the right side of a market maker sell model? Are we in an area of accumulation? Are we in an area of manipulation? Are we in the area of distribution? You always want to be participating in that distribution leg. That's where you're going to get your lowest resistance liquidity runs, when you're in that distribution leg. But if you can't identify, I'm in the distribution leg, Oops, upside the head. Yeah, oops, upside the head. Hey, here, learn to share. I told you we all speak typo. You ain't got to go back and fix it. We all speak typo. This guy knows his stuff and giving it to you straight. Yeah, I mean, I'm just a dude from Fort Lauderdale, Florida, man. I share it the way I understand it. If it makes sense to you the way I share it, hey, man, welcome. If it don't make sense to you, ask a question. Ask a question and we'll, you know what I'm saying, we'll get you there. We'll get you there. Because this stuff right here, it changed my life. You know what I'm saying? It's like for all those people who say, oh, there's no algorithm. Hey, man, get out of here with that. You can believe what you want to believe. You're not going to change my mind, man. Because growing up in Fort Lauderdale, Florida, they didn't teach me this. It's a guy named Michael J. Huddleston who taught me this stuff for free. And I went back and I did the work. And now I'm able to, it ain't nobody else in my family that know how to trade. Nobody talked about trading when I was growing up. And now I can sit up here and I can repeatedly take money out of the market over and over and over and over and over. Oh no, paid membership, WAP links. What you mean, oh no? what you mean, oh no? You ain't got to click that link. Ain't nobody tell you to go click that link. That's on you. If you want to click the link and join the gang, welcome. If not, don't click it. It's about, oh no. Hey, somebody tell Wild Deuces how quickly I throw block parties. Somebody tell Wild Deuces what's over there. Somebody tell Deuces what's over there.
Houston, we have a problem.
Bruh.
What he say, crickets? What he said, crickets? Okay.
Wait a minute. Who are you?
Okay, Deuces. Wild Deuces. We about to chuck up the Deuces. Where is it? I don't want to hide user from channel, put in timeout. I wish it had a ban. See ya. Wild Deuces out of here. He gone. I was back testing a lot on Nasdaq and S&P. Then I saw that we need a lot of money to start because of lot contract. No, you don't need a whole lot of money to start trading. You don't need a lot of money to start trading. What you want to do is what you want to do. You want to back test, right? And what back testing is, right? What back testing is going back through, right? Going back through the charts, just like how I was talking about what we did today, right? I was talking like me and the gang, we talked about this stuff in the morning before it happened. Right, identified the levels that we was looking to support price, like the PD arrays. We want to see a support. PD arrays we want to see act as resistance. We have our targets, right? We got our targets up there, right? This high up there from the continuous contract. We got our targets. We got everything we're looking for. Then we wait for opportunities to participate. Right now, what you do in your back testing, you do exactly what we did today. You go back through price and you see what did price use as support or resistance in form of PD arrays? What time of day did it do it? Right? And you take diligent notes, right? You take diligent notes and you're doing it based off what Michael teaches. And as you're seeing it, then you start to say, hey, my eye draws towards fair value gaps easily. I can see fair value gaps. As soon as I look at my chart, I can see fair value gaps. Or you be like, man, I can't see those fair value gaps, but my eye draws to order blocks quickly. I can see order blocks very well. I can see breakers very well, right? I see breakers good. My eye draws to that, right? While you're looking at what is price doing, you start to figure out this is what I can see well. right? And then when you figure out this is what I can see well, then you start to develop your entry model based around what you can see well, right? And then as you back test, then you start going back through price during the time when you're going to be trading, right? Like this highlighted area here, this is the New York session from the pre-market to the close, right? Then you go back through time and you look at the time you're going to be trading, and you can say, okay, I see price did this during this time. I see my model. My model is a come to a higher time frame PD array, right? Give me a breaking market, come to a hourly PD array, sweep of liquidity, bullish fair value gap, whatever. Give me a bullish breaking market structure on the 5-minute time frame, and then a retracement back down into a discount, bullish fair value gap, or bullish bullish inversion fair value gap, right? Meaning a SIBI that's becoming inversion, right? That's my model. Then you go back through price and you study that during your time window and see how often that pans out. And then you be like, okay, out of 300 trading days, I see that my model panned out with a 75% strike rate. So that's good enough for me. And then you start tape reading. You start tape reading and watching it in real time, and you identify, okay, boom, here's my model. I would enter here. Let's see, once you do that for a while and you comfortable with tape reading, then you start paper trading it, right? Okay, boom, here's my model. Once you get comfortable with paper trading, and all this time, you're saving your money, right? You're saving your money, and you're saving your money, getting ready, right? So then you say, okay, now I got me $2,000. I'm gonna put this into my broker account, right? I'm gonna go with whatever broker I want to go with, and then you start trading. Like most time people try to get a discount broker where you only have to have a certain amount of capital to like enter the futures, and it's not a large amount, right? So most discount brokers, right, if you're trading the micros, you want to start out trading the micros. If you trade the micro Nasdaq, you only need $100 per contract to open one position, and you want to start out trading just one contract. So if you start out with $2,000 in your account, right, and you start out trading one contract, that's the same thing as buying a 50K eval, because they only gonna give you $2,000 worth of drawdown, and that's just your own money, and you could just bill it slow, trading the micro NQ. Right, just start trading the micro NQ with a discount broker like Intraday, AMP. You know what I'm saying? Intraday and Ninja Trader, they the same thing, right? With a discount broker, you only need like $100 per contract. Start trading one contract and then grow your capital. Once you start growing your capital, then you can move up to 2 contracts or 3 contracts. Just keep growing your capital until you get enough money in there to get ready to move over to a mini. Right? And how do you know when you're ready to move over to a mini? When your capital large enough to trade 10 micros. If it's large enough to trade 10 micros, you can trade 1 mini. That's the same thing, right? And then you can move over to the minis, right? When do I switch up? That's up to you. How much you're willing to risk per trade, you know what I'm saying? That's up to you. But if you want to be able to fast track it, right? Once you back test, once you you tape read, once you paper trade, then you can go over to somebody like Tradeovate or Apex. And Tradeovate, like right now, you can get a 50K account for like $87, right? Because they got like 40% off right now. You get a 50K account for $87, right? One-time fee, you don't have to repay it. You got 30 days to pass it, right? If you pass it within 30 days, right, you only got $2,000 in drawdown, right? So you want to go in trade in micros, you know what I'm saying? Unless you're super proficient at trading your strategy already, go in trade in micros. You got $2,000 in drawdown, just like you were starting out with a $2,000 account, right? You got 30 days to pass it. Once you pass it, right, then you can move into a funded account where you can start withdrawing money out. Right, so all you did was put $87 in, right? If you get to the point where you can start withdrawing money, right, Once you get to the funded phase, once you make $3,000 in the funded phase, right, you can take out $1,500. Right, once you make $3,000 in the funded phase with Tradeify, you can take out $1,500. Right, you take out the $1,500, they're gonna keep 10%. You're gonna get $1,350. They're gonna send you $1,350. Right, and then you can take that $1,350, right, pay your taxes on it, right, and then you take the rest and put it into your what's name. If you stay in a state like Georgia, you got to pay state tax and federal tax. So you might as well just go ahead and knock off about a good 25-30% off of that right there. Then take the rest of it, boom, and put it into your personal account. Right? Then you get to 3,000 again with them, right? You can request 2,000, right? They're gonna send you 1,800. Take 10%, right? You pay your taxes on that 1,800, right? Put that money into your account, right? So you don't need a lot of money to start trading, right? You don't need a lot of money to start. If you know how to trade, you can start trading with less than $100 if you go through a prop firm, right? But if you don't want to trade through a prop firm, all you gotta do is get you about $2,000, throw it into an account, and trade with one micro. Start trading. There you go. Cameron, you still in here? Oh, I'm talking to myself. I just looked over there and I seen Wild Deuce's name still over there, but all the messages gone. It just was funny to me. I ain't had to kick nobody in a long time. When last time I had to kick somebody out? I ain't had to kick nobody out in a long time. Why did I kick him out this time? What did he say to make me kick him out? What did he say? He said something in the chat. I can't remember what he said. Okay, that's what's up. Hey, man, that's all I got. Anybody got anything for me? We love the info, always helpful. I appreciate that gratitude. Ralph Wiggum. Tim, apologies if I offended you. I was just joking with you. A friend said he was watching your stuff. Oh, that's Wild Deuces. Hey, y'all, Wild Deuces came back. Wild Deuces. Hey, how do I unblock you? You say you were playing Wild Deuces? I go crazy with the block game. Unhide user. Wild Deuces. Can you see again, Wild Deuces? Is your other I go, hey, I'm so quick with it. Hey, Wild Deuces, you should be, your other channel should be back. Hey, Wild Deuces, why you got so many channels, man? You a professional troll. Hey, professional trolls have burner accounts. Hey, man, that's all I got. What's this weekend? Hey, I want to jollipize to everybody that's got the Smart Money Manuscript. I accidentally did the Q&A, the monthly Q&A on the first Saturday instead of the second Saturday. So if that threw everybody off this month, I'm sorry. But next month we're gonna be on track next month. It's the second Saturday when we do the monthly Q&A for the Smart Money Manuscript. We don't have anything. We ain't got nothing coming up as far as the gang. So since this week we was like kind of out of whack. I had a lot of stuff going on, had appointments and stuff. So Sunday I'm gonna do a weekend chart prep Sunday evening. All right, so Sunday evening, we're going to do a weekend chart prep. And I'll send out the link. Sunday afternoon. We're going to do a weekend chart prep Sunday evening to get ready for next week. All right? Y'all enjoy y'all weekend, man. Again, if this was your first time tuning in, I appreciate you for tuning in. Give yourself a round of applause. You could have been anywhere else in the world, but you chose to be here with me. And until the next time I decide to get on Al Gore's internet and share my thoughts on this thing that we call price action, it's your boy, Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That just mean Big Spider if you ain't hablo español. Y'all be safe. I ain't these trading streets, man. Gone.